Hi, it's Rob Moore here from the Progressive Property Group. I've managed to get a very rare interview with Mark Homer, who also co-founded Progressive back in 2006. Mark's been investing in property since 2003. We've bought and we own a portfolio of 592 properties that we own or co-own together. And the start of this year, we launched an online training to share Mark's top 10 property predictions for the property market for this year. And we had, I think, 7,000 people book on the first training. We could only get 1,000 on. We did a replay, we had some technical issues, and I think there were a good 8,000 or 9,000 people in total that weren't able to get access to the training that Mark delivered. So we've created this video for you to share our top 10 predictions for property investing in 2016. Now, we don't have a crystal ball. I think we've probably got enough experience to be able to give you some insight that you might want to put into your property investing strategy or to even share with other people. At the same time, probably not going to get all these right. We're going to do our best. We're going to discuss house prices, rents, some of the new tax changes, etc. So here we go. I'm going to ask Mark the first question, which is house prices. Mark, what do you think is going to happen to house prices through 2016?
Well, I think 2016 is a really interesting year because we've got a lot of changes in terms of tax, and tax tends to determine people's behaviour, their buying patterns, and certainly in the short term it will influence the market quite a lot. So the biggest change that's happening this year, from April, we're going to have stamp duty of 3% on all buy-to-let purchases. So prior to April, certainly in this period now, we're in January 2016, there's almost a mini frenzy going on where people are trying to get their buy-to-let purchases completed so that they don't pay the extra 3% stamp duty on the purchase price. So I think really all up until probably end of February, maybe even into early March, you're going to see a big flurry of activity with people trying to buy properties. And of course, as soon as it gets to mid-March, it's definitely too late, even probably for cash purchases, to buy and not to be hit with that 3% stamp duty. So the market is just going to slow right down, I think, on those small, buy-to-let type properties and maybe the middle market HMOs. In the normal residential market, which actually is the biggest part of the market, where there's homeowners buying to live in, well, that shouldn't really be affected too much. But certainly on the buy-to-let type properties and the HMO type properties, I think you're going to get a huge buzz before before mid-March, and then after then it's going to fall off a cliff. So you're going to get a period through the rest of the spring into the summer where there's going to be some big opportunities to buy properties like that quite cheaply. I think in the medium term it won't affect it too much, but you're going to get all the activity pushed to the beginning of the year, so your opportunities to get stuff cheaper are going to come towards the middle of the year.
Question 2 then in the top 10 property predictions is all around the change in tax laws we've had, where you no longer have the ability to offset as much of your interest relief against taxation on your property portfolio. So we're going to ask this question in two parts. Part 2A is, what does that mean? What is it? And then 2B is the implication it has on the market. So Mark, first off, can you tell us what these mortgage interest tax changes are?
Well, in simple terms, you've historically been able to offset all of the costs of running your buy-to-let property against the rent, and effectively you pay tax on the difference. But the big change that's coming, and it's coming from 2017, is where you're not going to be able to offset all of the mortgage interest against the rent. Certainly if you're a higher rate taxpayer and you own the property personally, and that's a critical difference, you'll be able to offset about half of the mortgage interest. Now, it's not quite that simple. There's quite a lot of complication to it, but you're going to be able to offset about half. So let's say the rent was $300 a month. Let's say the mortgage interest was $150 a month. Well, if there were no other costs, you'd then pay tax on £150 a month, the profit. Well, in the scenario where you're a higher rate taxpayer, you may be able to offset around half of that. So that would be £75 a month. You could take off the rent, meaning you pay tax on $225. Obviously, if you had other costs, then it would reduce further. So that's going to be quite a big change, and I think it's going to affect the way in which people buy. and it's going to affect their behaviour. So lots of people are going to be buying limited companies, and they're going to be able to structure their purchases in other ways to reduce their income tax liability.
I think there's a lot of fear around this, and anytime there's any change in the property market, I've seen this now for a decade, dozens of times, there's this initial fear where it's like, oh, game's over, it's dead. The thing that I kind of immediately thought was, well, if we're not going to be able to make as much profit, we've got to look at making profit another way. So we either look at a different strategy or we bump the rents up. And what are your thoughts on what these implications are going to be in reality? What are you going to change in your property investing strategy? Can we bump the rents up?
Well, the credit crunch came along, 2008, 2009, people thought it was the end of the market. And buy-to-let's finished, and I remember seeing in the Telegraph...
End of the world.
End of the world. I remember seeing in the Telegraph, the last buy-to-let mortgage lender closes its doors.
Buy-to-let is dead.
Yeah. And I kind of, I'd been investing in residential property maybe for, 5 years at that point. I hadn't seen anything quite so big. So whilst I didn't buy into it, it certainly affected my psychology a little bit more. But this is a hell of a lot smaller than that in terms of, a change in the marketplace. And I think what we all need to concentrate on is the fact that there are a lot of people in this country that need to rent. They're not going to be able to get, enough deposits or, reach the required mortgage criteria in order to purchase. So the market is going to continue in a big way. It's just going to change. And obviously the government's trying to change behaviour. I suspect, really, they're trying to raise money, and they're saying, well, we'll change people's behaviour by putting tax up because all those kind of nasty buy-to-let landlords who actually a lot of the population, are not particularly keen on. Maybe there's some jealousy there. The government have tapped into that, and they've worked a way of kind of raising some money. But fundamentally, the market is more powerful than the government, certainly in the short to medium term. So yes, they're fiddling at the fringes. Yes, they'll bring some more, help to buy in and other schemes to help purchasers, and maybe there will be less buy-to-let landlords. In fact, I think that there probably will be. But in the main...
It's a good thing, isn't it? Do we want as many buy-to-let landlords?
Well, less buy-to-let landlords...
Being selfish, from an investor's point of view.
Less buy-to-let landlords means, critically, that rents are going to have to rise. We've had 5% on average rental increases the last few years, certainly since the recession. I think that's going to go into double digits. I think we're going to get big rent increases, and it's going to go on for a number of years. If you look at the examples of Australia and New Zealand, where they changed the tax laws, it was a little bit different, but it certainly reduced the amount of landlords that there were. Rents really strongly started to rise, and what will happen is as these rents start going up, you'll get kind of pressure groups like Shelter and other groups who are kind of on the side of the tenant, who are going to be saying, rents are rising, really, really strongly, and government, maybe you need to think again or find a way of controlling these rents, and that pressure will probably become stronger than their will to take money off buy-to-let landlords, and there'll probably need to be some kind of modification in the tax law or some other change in order to come back, and everything will reach kind of equilibrium in the long term. So those rents are going to start going up in a much bigger way. Landlords are going to need to have a bigger net profit in order to cover all their costs. Yes, some are going to use limited companies, but there's going to be a lot of old landlords who don't transfer, don't know about this, and they're going to end up needing more rent to stay in the game. And if they don't stay in the game, well, there's going to be less buy-to-let properties, more tenants are going to be chasing less properties, and therefore rents will have to rise further.
So question 3, Mark, in a moment, is going to be about how we adapt to these new tax grab changes that everyone's calling it. But I've seen in the last decade a lot of these what we might deem to be significant changes. And normally what happens is it gets some kind of newbie landlords or wannabe landlords or landlords who've had enough, kind of gets them out of the market. You hear a lot of them are selling up at the moment. And what you find is those that have a bit more of a long-term view or want to stay in it for the long term, they may be a little bit more keen to evolve and innovate, if you like. they often find new ways around this, because at the end of the day we're having a dance, aren't we, between us and the government. It's like, what changes are they going to put in that are going to help us, that we're going to be able to implement and learn about, and then also what changes are not going to help us that we're going to have to kind of move around. And that's a moving target. It's going to always be like that for the next 60 years, and we've just got to get used to it. So Mark, what ideas have you got? What can you see us as landlords can do to react to these tax grabs to make more income, basically?
Well, I think, there's two main things, aren't there? There's the stamp duty change, and then there's the mortgage interest offset, the reduction in the ability to offset all the mortgage interest. And I think with the stamp duty, you're just going to have to pay it. There's going to be another 3% on top. If it's a little 100 grand house, well, it's going to need another 3 grand's worth of stamp duty. If it's a HMO and it's costing you, 200, 250, well, it's going to be a little bit more. Maybe you'll be into 6,000 or 8,000. I think in the bigger scheme of things, if you're making a 20-year investment, as you should be, it's not going to make a massive difference. Maybe you'll need to negotiate a little bit harder with the vendor. I think sellers are going to have to be, certainly on those kind of buy-to-let properties, they're going to have to be more negotiable. You maybe take a little bit out of the estate agent. They can sometimes give a little bit back to the seller in terms of their fees to reduce the cost of the purchase. So I think that side of it has less impact. I think with the mortgage interest offset changes, there's going to be more that you can do. They have a bigger potential impact, but there's also more that you can do to control and in some way mitigate that issue. So the first thing is a lot of landlords are going to buy in limited companies, because limited companies are pretty much exempt from these new rules. You're going to be able to offset all of the costs as the rules stand at the moment. So at the moment there are a lot of buy-to-let lenders gearing up to release limited company mortgages. We've already seen it with Aldermore. They're offering a limited company range. And they're going to be done at the same or similar rates to buying in your personal name. And I know I've spoken to a number of other brokers and lenders who have told me that in the background the lenders are already working on a whole suite of limited company mortgages. So I think that's going to be a key change, that most buy-to-let investors are going to be buying in limited companies very shortly. In fact, I think there's been 6,000 limited companies set up to purchase properties since these new rules were released. Now obviously they don't start until 2017, and the full effect of them doesn't come in until 2020. So some people on existing properties, on their existing portfolios, are kind of hedging their bets, because I don't think this is quite over yet. I think the government have come out, there's been 2 rounds of changes where we've had the autumn statement, we've had the budget, and in those 2 kind of information dumps releases, obviously there's been 2 sets of new changes that have come along, and there's also a couple of consultations out at the moment on further changes. So this is not over yet, and I suspect that the changes that have come in will probably need to be rethought again or changed slightly as we go along, because I don't think the government really understand what all the what the impact of this is going to be, certainly in the medium to long term. So there'll need to be further changes. I think the other thing that landlords are going to be doing is they're going to be buying properties and making sure that they can put good refurbs through, because as long as you get a refurb through which is on a property which needs work doing on it, which is offsettable against the mortgage interest, because you're repairing rather than improving a property, that cost can be offset against all of the other properties within your personal portfolio. So I know a lot of landlords who are buying properties that do need a little bit more work doing to them, and they're doing more refurbs, and of course they're making sure, in addition to that they're offsetting all of the other costs of running their business. I know lots of landlords who don't necessarily put their mileage in, or don't necessarily put the costs of all the stationery in, or all those other little things that you do to run your property portfolio that actually they're legitimate expenses that need to be offset against the rent. So I think people are going to focus on that a lot more now, and make sure that all of the other things apart from the mortgage interest actually go in against the rent, because you can offset all of those other expenses in their entirety.
I think also if you talk to people who've made a lot of money in property for a long time, certainly Mark and I have got some friends that have made billions in property, the one thing that we all say consistently is looking to add value. So if you're just looking to buy single lets and there's a bit of stamp duty and maybe there's a tiny bit more of a cost and the refurb can't really add any value, you're not really extracting any uplift in that. Whereas if you can convert a property and change the use, for example, or if you can let out the rooms or you can add significant value, then paying an extra couple of grand in stamp duty isn't really a big thing. There's obviously a lot of relaxations that have happened over the last few years in laws around converting properties into commercial units, so maybe old offices into flats, commercial to residential, and you'll see a lot more people doing HMOs where the cash flow is much higher. Those of you that are watching that are already doing that, you're probably going to be thinking, well, I'm going to be focusing a lot more on that and not really doing so many buy-to-lets anymore. And those of you that have been the traditional buy-to-let landlords, I think it's probably time for you to start looking at investing strategies that's more more income-based than capital-based, where you can significantly add value to a property, or if you can even change its use. You can turn a nursing home into flats. You can turn it into your hotels, boutique rooms, serviced accommodation, apartments, all these kind of things are where the future is of making more cash flow. So being more concerned on the income than the capital and adding value. So property prediction number 4 is around how people's way of life, how they live has changed and how that affects being an investor and a landlord. And what you're finding at the moment is population is up and up and up and up and up. The government aren't building any houses. People are moving jobs a lot. The world is more global and people are traveling from country to country to country. Prices of properties are going up and up and up, so it's harder for people to get on the first, be a first-time buyer and get on the ladder. And all of these things are creating change in the property market for you as an investor and landlord, and also great opportunity. And you'd have probably already noticed that there's a lot more of these almost disruptive niche industries where people are renting out rooms and service accommodations and boutique HMOs and all that kind of stuff. So Mark, how do you think the way people are living, is it affecting kind of how we invest in HMOs and room rents, and what's it doing to rents? Do you think it's pushing them up?
Well, I think the first thing is that when people rent a single let, obviously they've got all the costs, which would be the gas, the electric, the council tax and everything like that on top of the rent. So a major benefit with a HMO is that all of that is split between 5 or 6 people. And if it's a bigger HMO, it may be more people. So there's definitely a cost saving for the tenant, and of course there's an uplift in the rent for the landlord because that difference or that saving gets split, and effectively that's driven bigger demand in the HMO space, and certainly for higher quality accommodation as well. HMOs years ago used to be very low end and really for the bottom rung of the market, but as things have got more expensive, and obviously there's more migration, there's a lot more Eastern Europeans and other migrants in the country, those HMO properties have become more and more popular and the rents have really started to react. Now, when you think in terms of these buy-to-let tax changes and what's going to happen in terms of the mortgage offset or the inability to offset all the mortgage interest, there's going to be less effect on HMO type buildings because less of the total cost is a less of a proportion of that is actually the mortgage interest. More of it with a HMO is going to be other costs, ones I've just mentioned, along with cleaning and maybe getting the TV license and all those other things that it actually costs to run a HMO are fully offsettable against your income, against your rent. So there's certainly going to be a benefit for landlords moving into that space because they're going to end up, the ones that own the properties personally, are going to end up with more net income than if they had a single let, and they're certainly going to be taxed in a less harsh way. So there's going to be a bigger shift. There's probably going to be more people buying HMOs. Of course, the demand is there as well, and of course, more tenants are going to want them as well because the single let rents are probably going to increase exponentially because landlords who own single lets are going to have to increase the rents in order to pay the extra tax. So I see it as a big growth area, certainly on the supply side because of increase in population and certainly a big part of that increase in population is at the lower end. They're people on lower wages who have come to the country, to work or to get on. And that certainly benefits that HMO kind of environment on smaller rooms and lower rental type properties.
The fifth property prediction is around moving into bigger developments. Now, when Mark and I started years ago, we used to buy loads of single lets, and we wanted to own thousands of them, like Andreas Paniotto. And then you find that it's not really worth your time so much, and you can maybe get a better benefit from a time perspective with HMOs. And then with a lot of the regulations relaxing around planning, we're finding a lot more progressive community investors and landlords in general are going into bigger developments and commercial conversion opportunities, converting nursing homes and pubs and all these bigger, older, disused buildings back into flats and rooms. So Mark, just talk a bit about that. Do you think there's a growth opportunity there?
I think the main benefit and the big opportunity with those kind of buildings is there are less people chasing them. Because it takes, more knowledge, probably more cash, easy when you know where to get the money from, and, bigger sums of money to buy those buildings, there are a lot less people chasing them. Certainly when people start out, they start with the single lets and the HMOs and the smaller type properties, and people don't even think about taking a big, office or pub or, community centre and converting it into residential, because it's specialist, and, you need to kind of cut your teeth on smaller stuff first and get the experience to move into that. So it's a nice space to be in, certainly because there are less of your buy-to-let types doing it, if any, and the big funds and the big institutional investors are not necessarily in that space, because they're buying the stuff in the kind of tens of millions. So you're in a bit of a wormhole. You're in between those two sectors. It's certainly, there's reduced competition for those kind of properties. And actually, most traditional developers, they will buy buildings like that and then sell the units that they develop. So if you can kind of take units like that, find a way of developing them and then keep them to rent, actually if you increase the density, you can sometimes pay a little bit more than some of those traditional developers, because you haven't then got to sell the units on afterwards, and you can buy for yield. So there's a definite opportunity, and it's a space I really like myself. Whilst the government seems intent on increasing tax for buy-to-let investors, actually they seem to be very pro developers and new units being created. Obviously, they say they're trying to solve the housing crisis and provide more units for people to live in. So actually developing new units and converting existing buildings is quite popular with the government at the moment. Hence, they've brought in these permitted development rights for office to residential conversions, and they certainly promise to bring more benefits in over the next few months and years. There's agricultural, where you can take agricultural dwellings and barns and convert them into residential using permitted development. And there are, changes with B2, which is warehouses that can go into residential, and shops as well, and a lot more is to come. So we're certainly in a period where there's an opportunity to get hold of those buildings. Certainly in 2016, you'll be able to agree purchases, and I think the legislation will get easier and easier as time goes on. So the opportunity is not going to be there forever. Once everybody has kind of bought these buildings and taken all the empty commercial properties, or a lot of them, using the benefits of these kind of planning changes and drops in kind of legislative requirements, there'll be less of these buildings and the prices will be much higher. The prices have reacted already a little bit since 2008. I've seen, certainly in our area, maybe the prices have gone up 30, 40, 50% since that period, but there's still a long way to go and still a good margin in there for people looking to develop those buildings into residential until everybody else gets onto it, and the supply of those properties, dries up and finishes.
This has been a huge growth area. My parents used to own pubs and bars and small hotels their whole life, and actually the very pub that my parents owned in Peterborough got knocked down, and that's been developed. We've bought some old pubs that we're converting now, and some have converted already, into flats or rooms. A huge growth area. It's not something we saw 10 years ago. In 10 years' time, when they're all done, something's going to have to change. They're probably going to have to build again. And you know, I think sometimes there's a bit of a government versus landlord thing. You know, landlords hate the government for what they're doing, and it seems that a lot of people hate landlords. I think in this instance, it's a great thing that the government are doing, because they realise that us as landlords and developers, part-time developers, can really help solve the housing crisis. We can bring a lot of the buildings that aren't really in use anymore, like pubs aren't really being used, or some buildings that have gone a bit into disrepair. So it's great for the community that can be done. That's why there's loads of offsettable costs, and that's why the profit margins are high, and that's mostly what we do now. Prediction number 6, interest rates, the perennial debate. What's going to happen to interest rates in 2016? Now, for years, people have been saying they've got to go up, they've got to go up. They haven't gone up. Mark, in 2016, are they going to go up?
Well, I think there's going to be no change in interest rates in 2016. There are lots of commentators that would disagree with me. But I think if you read the Bank of England inflation report, like I do, and you look at the financial press, I mean, today is the 19th of January 2016, you can see that China is continuing to slow down, maybe not quite as much as people feared, but it is slowing. I think growth's in the 6 to 7% range now. I mean, it sounds massive compared to our economies, but you know, it's the slowest it's been growing for 20 years, so it's quite a big thing for China. Because of that, and other factors, oil prices have come off.
Yeah, I know. You got me to invest in oil, 45% down.
I did the same, and you know, oil will come back in the medium to long term, of course. But you've got a lot of shale producers in the US, you know, and obviously they found a cheaper way to access these oil supplies. So there's a lot of supply out there, and of course, countries like China and the developing world is using less of that, and oil prices really feed into everything we do. You know, all the energy, you know, our cars, and you know, even products which are made in factories. You know, they become slightly cheaper, or the cost of producing them becomes cheaper if oil prices come down. Linked to that, commodity prices have come off quite a lot. So, you know, copper and all the metals and steel and everything like that, the demand has reduced, and also the price of those commodities has reduced quite a lot as well. So all of those, you know, changes mean that the value or the price of finished goods and products, consumer prices, you know, there isn't pressure on those to go up. So inflation, therefore, is controlled. There still isn't really very much inflation, so therefore the risk that interest rates will go up again is reduced. When they do start going up, and of course it's going to happen, I expect probably you'll get the first rise in 2017. You know, the Americans have already had one small rise, or their first rise since the credit crunch. When they do start going up, the Governor of the Bank of England thinks the new normal is going to be 2.5% to 3%. So rather than being kind of in the 5% range where they were a number of years ago before the credit crunch, new normal probably 2 to 3%, and it could take another 3 years to get there. So it's going to be slow rises up to that level, and you know, it should enable us the ability to predict. But of course, if you're concerned about interest rates, you know, no one is you know, everybody comes out with predictions, and the predictions are frequently wrong. You know, they are very, very often wrong. If you're concerned about that, then just fix your mortgage rates. There's some great cheap fixed rates out there because of these low inflation predictions, and low in interest rate predictions for the future, and fixed rates will control that risk for you.
Property prediction number 7 for 2016 then is what's going to happen in the mortgage market.
I think the main change in 2016 is going to be the ability to buy on a buy-to-let basis using limited company. You know, the big buy-to-let lenders like the Mortgage Works or Birmingham Midshires, they're all going to be offering limited company mortgages, I think. I mean, in the background, they're preparing to release them now. There's obviously going to be some tax benefits of buying in a limited company, and I think they're going to have to react in order to keep their lending volumes going. That's the first big change. The next kind of continuation, and actually, you know, it's continued to get better, is the fact that these long-term fixed rates are still cheap, and probably even cheaper than they were. You know, you can do a long-term fixed rate, a 5-year fix, in the kind of low threes, which is pretty much the cheapest I've ever seen those. And of course, you know, a few years ago I was saying, I don't think they'll ever get any cheaper. Well, I was wrong, they have. And it's probably quite a good time to jump on those kind of deals. I don't think that they will get any cheaper. I said that before, but I really don't think they're going to get any cheaper than that. You've got a variety of factors. Obviously, the Bank of England's kept base rate at 0.5%, and interest rate rises seem less likely, and they certainly seem, the curve seems more shallow. That's benefited, but also more banks are lending now. There's definitely more competition than there has been at any time since 2009. There's more confidence in the marketplace. Institutions and investors are happier to lend to banks because they feel like the economy has turned round. There's a solid growing economy now. Wages are now growing. So I think there are more mortgage products coming out. I think that will continue. The rates will be even keener, and they're having to compete harder and harder. So what we are seeing is that more lenders are accepting property-based income rather than insisting on you having other sources of income in order to get a buy-to-let mortgage. And I think there'll be more choice. One of the big changes from the government is going to be that they're going to control the stress test on new mortgages. So your 125% rental coverage, and maybe there's going to be something in there that says that needs to be calculated on a notional of interest rate of 5%. There's a consultation paper out at the moment. Those two numbers are muted in there at a 5% and a 125 rental coverage. Whatever happens, it looks like they will implement that. And your purchasers are going to need to meet that stress test, which is probably a good thing anyway, because it just protects you in the future, and the government and the Bank of England say that they're doing that to make sure that there's not a big crash in the future, which will benefit us all.
If you look at a cycle of the way lending happens, obviously when it gets towards the peak of any kind of cycle where everyone's kind of really positive, lending is free and easy. And then when you've had a crash or a correction, lending tightens up, and no banks want to really take as much risk. And you might say we're somewhere in the middle of that now, between it being really hard to get a mortgage in 2007 and 8, to being ridiculously easy like it was in 2005, where you could get ninja loans where no income, no job, no assets, and you could still get a mortgage. And I suppose my prediction would be maybe we're halfway, maybe a little bit further than halfway through that cycle. So I predict that not just this year, but in the next few years, lenders will have to slightly ease their criteria if they want to keep the money flow going. And as more lenders come into the market and get competitive, they compete against each other. So they bring out competitive products to try and win some of the business. And you get that kind of free market competition where margins will reduce. And I think over the next few years that's going to happen more. Property prediction number 8 then is alternative finance methods. Now, one of the benefits of it being harder to get mortgage over the last few years is that you get other disruptive or innovative finance vehicles, private investors, etc., coming into the market. So, Mark, can you talk a bit about where you think other lenders or finance vehicles or houses or private individuals would be putting their money into property in 2016?
Well, as interest rates have stayed low for such a long period of time, there are a lot of people who have got savings in the bank and other investments, stock market investments as well, which haven't done that well. The stock market's dropped again, in recent weeks. And I think more and more people realise that actually, other forms of investment, they're probably going to get maybe 5, 6, 7% maximum over the long term. And as rates have stayed low, more and more people have looked to get a higher return on their money elsewhere. And as the property market has grown, the economic position has stabilised and is now growing, and unemployment is going down, wages are going up. People feel happier. They feel happier in their job. They feel more secure. And they're more happy to lend on a joint venture basis to people doing property deals. I know, I was at a big event last night, and there were a lot more people there talking to me, interested in lending money for bigger developments or even little single lets. They were talking to other people in the crowd, and they were saying to me, oh, should I lend on this, or what security should I get, and what interest should I be paid, and all these kind of questions that are going around their head. So it's certainly something that people are looking to do more. There's more money around, they're more confident, and I know there's lots of property investors who are willing to kind of place that money and provide interest, which is coming out of the deals that they're doing. So that's certainly a lot more popular. And I think it's easier to structure deals like that now because there are more solicitors who are able to put the charges on quicker and provide the security, who are used to doing those joint venture type deals.
I think there's been a real disruption in the movement of money over the last few years, and I think a lot of typical landlords, if you like, they kind of really look at what deposit do I need, what mortgage lender can I go with, and that's really the way, a more of a narrow view of finance. But as that's tightened up, money has moved, because if the banks aren't lending as much, then obviously money, the supply of it and the way it moves is changing. Interest rates come down, so private investors get lower returns elsewhere, so they have to look for higher returns. There's a need in the property space for landlords to have deposits because the mortgage companies aren't lending to them, so money changes. And if you look now where you can get money from, Funding Circle, I actually invest into Funding Circle as a lender. Now that's a relatively new disruptive method of finance. You might call it crowdfunding. There's a crowdfunding websites that you can invest money into and borrow money from. There's property-specific crowdfunding websites. There's peer-to-peer lending sites like Zopa. And the way that money is being lent now, the conventional banking system is really being challenged and really being disrupted. I know someone very well who runs the Angel's Den franchises, and actually he set up a property Angel's Den, and he's got access to billions of pounds. And that specific Angel's Den is lending to property investors, and many people in our progressive community have raised finance for developments and investments through Property Angel's Den. Now, Property Angel's Den didn't exist when you could really easily get ninja mortgages back in 2005 and 6. So I think more of these will open. I'm seeing more and more peer-to-peer lending and crowdfunding sites open, and more people prepared to lend their personal money as they look for better returns. Property prediction number 9 is all about hotspots. What's the next UK hotspot? Honestly, we get asked dozens of times a week, what's the up and coming area? What's the hotspot? We have a bit of an alternative view on hotspots. So Mark, do you want to discuss what you think about property hotspots?
I was only discussing with an investor this morning who asked me where I think the latest growth area will be for 2016. Will be, and he was asking that because he's had some big growth in a property in his local town. He was saying, I want to buy another one of those because I think it will go up massively next year, because it has done the last 2 years. And I think it's one of the most difficult things that you can kind of have in property, and that's deciding how much capital growth, or trying to predict how much capital growth each area will have over the next year. I think it's pretty much impossible to determine what that's going to be. I know what the yield of a property is going to be. I know how much rent I'm going to get versus the value. And that's something you can predict. And, I really pick areas based on what the yield's going to be, A, and B, can I manage it? I.e., have I got a good letting agents there, or, have I got a good rump of properties in that area to enable me to put somebody in to manage them? And I think they're the two starting points. So for me, that's what determines the hotspot, rather than these kind of cyclical changes which people assume will help them determine what capital growth is likely to be in different spots of the country over the next year or over the next 5 years. It's almost impossible to predict. Yes, London had some great growth, and at the moment, that's slowed, certainly in the middle. And that's rippling out. And of course, you could say into the regions, into the Midlands and into the North, they've probably got more growth than the middle of London at the moment, because they're paying catch up. The growth usually starts in the middle of London. So you could kind of say that, as the cycle moves into the kind of midpoint, and we're not quite in the middle of the cycle yet, but we're moving towards let's say the third in point. You could say that the growth spreads up and spreads out, and towards the end of the cycle, usually right at the end, it's the fringe areas, the areas that are most affected by big jumps in finance and the ability to raise finance at the lower end of the market, and for kind of, let's say, less competent borrowers. That big growth usually comes towards the end of the cycle, just before the next crash. So I don't think we're anywhere near that yet. I think we're probably only about a third of the way into the cycle, and we are seeing growth further out. But I think this notion of, Nottingham will grow more, or, maybe we'll have more growth in Glasgow this year because of this, and this, or because Crossrail's going in, or, because there's extra migration up there. I think there are so many variables on top of that affect capital growth that we don't know about, can't predict, and can't necessarily measure, that I think it's a very difficult thing to predict, and there's actually no point trying to predict it. Focus on the yield. You know what rent you're going to get versus the purchase price, so that's guaranteed, isn't it, almost, as long as the property's managed properly and you get the right tenant in there. And make sure you buy, within a reasonable distance of your home, or at least put the properties together so they can be properly managed. I think they're the things that you should be focusing on more than trying to pick individual areas based on capital growth that you expect may happen over the next few years.
You can actually predict what your income's going to be to the nearest probably 10 quid, because you can work out the gross yield, the net yield, you know what your costs are going to be, you know what your rent's going to be. So you can really almost to the penny work out what your income's going to be, but you cannot predict capital growth at all. So I think that's really what Mark's talking about. Also, I think people who are chasing hotspots and capital growth, I think they're speculators, not investors. I think they're looking for a short-term jump, and they're speculating, they're gambling basically. If you were to think about long-term investing and you were going to be in this market for 10 plus years, ultimately your area is probably going to get fairly consistent growth compared to other areas. Now, obviously, when prices drop significantly, the lower end areas are going to drop first before the higher end areas, and then as prices grow, you might get London growing first and then it rippling out. But if you look over the long term, they will be fairly consistent against each other. You're not going to have one city that grew 25% more over 10 years than another city. It's going to be fairly close. But the biggest cost is the management, the maintenance, the voids, the bad debt. They're the biggest costs, really, that erode your income. And the further away you invest, the less control and the more those costs go up. So, we invest in an area which isn't necessarily the sexiest area in the UK, but it works for us because we know it, we know the prices, we've got comparables, we've got experience, we've got a network of teams, so it keeps the cost down, we've got lower risk. So really, you can probably invest pretty close to where you are within 30 to 60 minutes. Don't chase all the shiny objects or, the Olympics is going to be here or they're building a new stadium here, because that's just very transient. And finally, property prediction number 10 for 2016. Mark, talk a little bit about some of the opportunities in 2016, maybe some alternative cash flow strategies.
Well, I think rent-to-rent's going to be another big one for 2016. There's going to be lots of landlords who are not looking to manage their properties or want to get out or just want to take a set monthly rental figure, as have been over the last few years. Loads of new investors coming in who don't necessarily have the capital but want to get going and want to start a little business. They'll find rent-to-rent's great. They probably won't be hit at all by the mortgage tax changes because they're not buying, and also they're not paying mortgage interest. They're probably just going to be paying rent to the landlord. So their tax position is not going to be changed. And in addition to that, there's going to be more tenants, probably because there'll be less landlords buying. Or should I say, there'll be more tenants because of immigration and more people arriving at the low end, and less supply of properties because there'll be less landlords buying. So I think rent to rent is going to be a very popular strategy and continue to grow. It may get regulated at some point in the future, we don't know. It's not on the horizon at the moment, so it's a great opportunity to get in another of those little wormholes. You've probably got a few years before it becomes saturated and more difficult to do, and then the strategy needs to move. Another great strategy that's emerging, that has been really driven by the growth of websites like Booking.com and Airbnb, is serviced accommodation, or as some people call it, kind of holiday letting. That's where you get an apartment typically, and it gets rented out on a nightly basis to individuals looking to stay in an area and maybe take an apartment rather than a hotel room. Great for the person renting because they end up with something much, much bigger, probably for a little bit cheaper. And of course, the landlord ends up with way more rent because they're renting the property out on a nightly basis. It's a business. People need to have cleaners and make sure the linen's changed and make sure the apartment is of really, really good quality internally, and make sure people are checked in, out, and manage their websites and all that sort of stuff. But actually there's some great business profits to be derived from that for people who focus on it and spend the time to grow that business. That is probably the biggest growth area that we're seeing across the country. And actually that strategy works very well in London as well, because the rentals actually do mirror the property prices more closely when you're renting on a nightly basis versus on a long-term basis, so the yields are way higher. And I know quite a few guys, certainly around central London, who are making significant monthly profits. I know one guy, I think he's in Pimlico, and he's making something like £8,000, £9,000 a month out of an apartment, because there's huge demand, really, really good nightly rentals, and there's some great profit there. Something that you couldn't do years ago because you didn't have all these websites which enable this fast online booking, and that's something that's really, really growing at the moment.
I think other things you'll see happening in 2016, you'll probably see more people sourcing and packaging up deals. Obviously, Mark thinks we're a third of the way into the cycle. I think we're maybe halfway in. So you're going to see a lot more people selling on their deals. I think we're going to have a lot more people come into the property marketing space. There are going to be a lot more people setting up as landlords, I believe, when they see growth of London and they kind of want to jump on. So I think you can also see a lot more people setting up and running training and courses on property investing. Whether you think that's right or wrong, that's kind of your call. That's obviously what Progressive Property does. But I think you're going to see more people coming in and doing that because that's an opportunity for them to make profit. I think it's really important for you moving into 2016 to make sure you have a capital and an income strategy. I see a lot of people just either doing a capital strategy, buying with equity, but not really having a lot of income to sustain either repaying the loans or to sustain the asset. And then I see some people coming in and setting up a trading business around packaging and selling deals or information marketing or maybe something like rent to rent, but they're not building an asset. All they really have is a trading business month to month. And I know many people who are landlords and investors come in because they want passive income. They want to build an asset base to replace their pension, maybe have a little bit more freedom. So I think it's really important for you to have an asset base, a capital strategy, and an income strategy. So I hope you've enjoyed the 10 property predictions for 2016. It would certainly be worth checking in this video in a few months' time, see if we're correct to any of them and see if the opportunities are still there for you. Now, this video is actually going to be put into the Progressive Property Academy. Our Progressive Academy is an online resource where we have many of these kind of videos and trainings that help you become a full-time landlord or property investor, and we teach you how to generate multiple streams of property income. We actually have a special offer on at the moment, which is about £1 is all that's needed for a trial. So there may be a link on the page, or you may have to search Progressive Property Academy. Go in, have a look, have a little bit of a free trial and see if you think that the information that we share with you can help you make more money in property. I want to thank you very much for watching this pretty long extended video. I want to thank Mark because he's very busy now buying all of his commercial properties and doing all these conversions. He doesn't have a lot of time anymore to do these interviews. So I want to say a big thank you, and remember, invest for freedom, choice and profit.